Hi guys, Manny from MC Personal Finance here, and welcome back to another video. In this video today, we're going to be discussing what goes into your FICO score and how you can check it for free. So you may be thinking, oh Manny, what's a good credit score ever going to do for me? Well, in the future, if you ever want something like a mortgage or a car loan, you're going to want to pay the least amount of interest as possible, right? A good credit score is the main factor in determining that. Now, your credit score isn't the only factor that goes into determining your interest rate, but it plays a pretty big part. Your income is also a big part of determining that interest rate, but if you have a higher credit score, lenders may be able to look past your income if it's lower than what they want for the best interest rate possible. Now, not all credit scores are FICO scores. FICO scores are the scores used by lenders when you're applying for new credit cards, for car loans, for student loans. You can also check an estimate of what your credit score is by using apps like Credit Karma or NerdWallet. Now they use Vantage scores, which are not the same thing as FICO scores, but they are a pretty good estimate. Like my Credit Karma score is only about 5 points off of what my FICO score is. And in this video specifically, we will be talking about just FICO scores. Now, what can your FICO score be? Well, it can be a range from 300 to 850. Now, once you hit the 770 to 780 mark, you'll tend to get the highest interest rates possible anyway, but it never hurts to flex and be like, yo, I got an 825 credit score. And what goes into determining that credit score? Well, there are 5 factors that go into that. The first of these is payment history. This accounts for 35% of your FICO score. And this includes paying your loans back on time, your credit cards back on time. And for this, it's at least the minimum balance. While I never advise carrying a balance on a credit card, if you're paying at least the minimum balance on a card, you won't be dinged. Now, most credit cards have a 30-day grace period, but once you pass that, and if you haven't paid at least the minimum balance, then it will be marked as a late payment, and that can stay up to your report for 7 years. This is why it's extremely important to treat your credit card like a debit card and to not spend more money than what you have, because missing a payment, even if it's just one, can greatly decrease your credit score and greatly increase the amount of interest that you would pay on a loan. The second factor that goes into determining your score is the amount owed. This accounts for 30% of your credit score. This is where credit utilization comes into play. So let's say you have a credit card with a $1,000 limit and you spend $500, and that's what it reports on your statement. Then your utilization rate is 50%, which is high. You want to keep your utilization rate at below 10%. But let's say you have a credit card with a $5,000 limit. You still have that same $500 balance, but yet your credit utilization rate is only 10%. And while it's the same balance, you're seen as less of a risk with the $5,000 credit line rather than the $1,000 line, because you're only using 10% of your available credit to you versus 50% of the available credit. This is also why you want to be able to pay as much off a loan or a credit card balance as possible, so that way your utilization rate stays low. The third factor that goes into determining your credit score is length of credit history. This accounts for 15% of your credit score. Now, this takes into account how old your oldest account is and also your average age of accounts. So let's say you've had one credit card for 10 months and you apply and get accepted for a new credit card. Your average age of accounts now turns into 5 months because you've had one credit card for 10 months and one for 0 months. 10 plus 0 is 10 divided by 2, which is the number of accounts. You get 5, which is your average age of accounts. Now, the fourth factor, which accounts for 10% of your score, is just credit mix. This is just different accounts like student loans, mortgage, credit cards. Now, this, you don't need to have one of every type of loan for your credit score to be in the excellent range, but having different types of credit helps. Now, the fifth and final factor that goes into determining your credit score is new credit. This also accounts for 10% of your credit score, and this takes into account your hard inquiries. Now, hard inquiries or hard pulls, as many people commonly refer to them as, is whenever you apply for a loan, a credit card, except in very special cases where it doesn't apply. But most of the time, when you apply for a credit card, you're going to get a hard pull on your account. Now, hard pulls are not always bad, because if you want a credit card, you're obviously going to have to take a hard pull on your account to get one. But if you have multiple, but if you have a lot, you're seen as more of a risk, because lenders are going to be thinking, is this guy just when you get a whole bunch of credit so that way you can spend it all and never be seen or heard from again. Now you have all this information that goes into what determines your FICO score, but now you want to check it. Like I mentioned before, if you want to check just an estimate of your credit score, you can use apps like Credit Karma or NerdWallet. But if you want an actual FICO score, you can sign up with Discover and they will provide you your FICO score, which you can check at any time free of charge that's updated monthly. Now, having a great credit score isn't the end-all be-all, but it will definitely help you when you're applying for loans and credit cards and when you want to pay the least amount of interest as possible. Thank you for watching this video. Make sure to like and subscribe. Comment down below what you want me to talk about on my next video. And until next time, peace.